Corporations. What types of corporations will we discuss? C Corp, S Corp, Benefit Corp. What are the advantages and disadvantages of running a corporation? Corporations are entities separate from the individual. They're something that the state or federal government recognizes that can operate and run a business. The advantages of corporations are you can get a management team to run the business. It can raise large amounts of capital. It's separate from the owners or individuals. It can be permanent. It can be passed down from generation to the next. It can be sold. And the owner's liability is limited to the investment, what the money that's put into the business. And if that money grows, whatever is remaining in the business. There are some disadvantages too to forming a corporation. They can be impersonal because you're not dealing with, a customer is not dealing with necessarily the person anymore, they're dealing with the business. Owners can have limited interest in the firm's activities. There can be, a lot of fees and taxes to get the business up and run and maintained. There could be a lot of procedures, report statements that are required by the governments or investors or owners. It can be difficult to do business in certain different states than the business entity is set up in. Two of the areas that we want to consider are whether is how the taxes are paid and how they flow through from the business operation to the government. So the two types of taxes that we want to identify are pass-through taxation, where the amount of profit is a statement that goes on to the owners, and they are responsible for paying taxes on the profits of the business. And these are often sole proprietorships, S Corps, and limited liability companies. Those all have pass-through taxation, or the owners are responsible for the taxes, whereas C corporations, they can pay tax directly to the government. So the C corporation pays tax to the government, and if any money is distributed from the C corporation to the owners, then the owners would be taxed as well. So oftentimes we hear this as double taxation, although this does not mean that the owner pays double the amount of taxes. It just means that there's two times where the owner might be taxed. Okay, one is where the business reports their profits and the business pays the tax, and the other one, if the owner takes any distribution, they would be taxed for those distributions. So it may be a question that you're asking, why is the C in front of corporation? I like to think of C corporations as just corporations, right? They're an independent legal entity owned by the shareholders. So that's the easiest way to remember it. C just stands for corporation. They're the standard corporation. C corporations are governed by the state that they're in. So they need to be named, and you can name your corporation. So you can establish a business name and name your corporation, and you register that corporation with the state that the business is operating in. You can file documents, and those documents will vary state to state. So we really need to look at what state are we forming the business in, and what are the legal requirements of those states. And then we typically issue stocks to the shareholders. Those are the owners of the company, and they will receive some type of certification that says they are the owners based on what % they own the business. So some of the features that we want to look at is C Corps can be owned by more than one person or more. They can be for profit, and they're usually for taking a company public. So one of the things that you want to note is that ownership can have more than 100 people own a C corporation, whereas some of our other entities has to be less than 100. Again, there's no personal liability in a C corporation if it's set up correctly. Personal assets can be transferred to the company, debt, financing, and equity investments. That means an owner can put money into their own company, and that's how a company can raise funds to start and run their business. One one of the things with C Corps is the double taxation issue, and that profits are shared with shareholders as dividends. So when they decide to share some of the profits, people who are the owners of the company, the shareholders, are given cash and they're given dividends, and then those owners would have to pay taxes on any distribution according to the state and federal government tax codes. So tax codes are, you'd have to file corporate tax. The entity itself would file the taxes, and then the federal income tax reporting. Corporation files a corporate return on Form 1120S and reports distributions to shareholders on a Schedule K1. So that K1 is the form that shareholders get when they are distributed funds from the entity. The paperwork is much more complex. So advantages and disadvantages. The advantages of forming a C Corp is their separate legal entity, liability protection, can be owned by other corporations, they can get corporate tax treatment, they may be attractive to employees, and they can have 100+ shareholders. Disadvantages, it's costly, it's time consuming to start. Double taxation, there's extensive paperwork. What are S corporations? They're like a regular C corporation, but the corporation asks the state in order to become an S corporation. So they're a federally recognized corporation. They must file through state where they're headquartered, and taxes are passed through to the shareholders. Any owner that works for the corporation must be paid reasonable compensation. That means if you are the owner of a business and you elect to go and get an S corporation from your state, they can move that classification from a C Corp to an S Corp, but the owners of the company, anyone that does work, has to be paid for any services that they provide within the organization. So if you become the manager of your S corporation, you would have to pay yourself as a salary of what a manager would do for that type of business in that industry. So again, to file an S Corp, you would file as a corporation in a state, and then all shareholders must vote to become an S Corp, and then file for S Corp status, and the government would grant you that status to change it from a C Corp to S. So one of the things that are mainly different is you would have to have less than 100 people. It would be for profit. You would have the liability protection. Again, the financing is similar. You would either transfer money from the owners to the business, or you would get a loan, or you would get an investor to invest. The profits are still shared with shareholders as dividends. Taxation is a little bit different because you can avoid some of the double taxation issues, and it can become a pass-through entity. So that would be one of the benefits of forming an S corporation. One of the other reasons that may not be specific is that sometimes people want to have an income statement like they're getting a regular job in order to get a personal car loan or a home loan. Having an S Corp as your business allows you to get paid as if you were an employee and as an owner, right? So if you can show monthly statements that you're actually getting paid for that managerial work, it's much easier for you to get a loan in those situations. So that's why many people do it. So the advantages are, there's more tax advantages because it goes from being a double taxation to a pass-through. It is a separate entity. They do have strict organizational processes. Shareholders are limited to 100. There is the issue of owners that do work have to be compensated for their work. They can't be owned by other corporations, and they must be owned by U.S. citizens. So these are some of the disadvantages. So these may or may not be specific to your state, and I always recommend talking to a lawyer because this information can change over time. And so this is something you want to have a discussion with your lawyer and see exactly what are the specifics for that entity at the time the business is formed. Next up, nonprofit organizations.